Welcome to the Geek Investor podcast, where technology meets investment insight. We break down the mechanics behind breakthrough innovations and uncover how they shape the future of the world's most investable companies.
If you're passionate about understanding not just how tech works, but how it builds real business value and investment potential, you're in the right place.
Like, subscribe, and let's explore the edge where engineering meets equity. Hosted by Ethan and Claire, and for full transparency, these are synthetic voices powered by Notebook LM.
So today we're really digging into a concept that's absolutely fundamental if you want to understand why some businesses last and others don't.
Right, we're talking about the business moat. It's a term you hear a lot, especially in investing circles.
Exactly. And we're going to unpack what it actually means, why it matters, and how you can start to identify one. Think of this as your guide to figuring out those core defenses.
Defenses that let a company not just, survive, but really thrive long-term. So let's get straight into it. The material we looked at kicks off with a great analogy.
The castle analogy. Yeah.
Exactly, the medieval castle with a big moat around it. How does that picture help us think about business?
It's a really good visual, isn't it? The moat around the castle, its whole purpose is to keep invaders out.
To make it hard to attack.
Right. Difficult, costly, risky for enemies.
Mm-hmm.
In business, the moat is basically the same idea. It's that sustainable competitive advantage.
The economic defenses.
Yeah, the economic defenses that stop competitors from just waltzing in, copying what you do, stealing your customers, or, forcing prices down so low that your profits disappear.
And this idea, it's really been popularized by Warren Buffett, hasn't it? The source material quotes him.
Mm-hmm. He famously said the key isn't just finding a fast-growing industry, but, and I'm paraphrasing slightly, figuring out the competitive advantage of a company, and crucially, the durability of that advantage.
Durability. That feels like the absolute core of it.
It is, because look, lots of companies can have a good year, maybe even a few good years. A great product, maybe.
But that's just today.
Exactly. Without a moat, that success is basically an invitation for competition. The source uses that simple lemonade stand example.
Yeah, the lemonade stand.
You set one up, it does well. What happens next?
Someone else sets one up right next door, then another one.
Right. Soon you've got price wars, everyone's cutting prices, and suddenly nobody's making much money anymore. That first successful stand, no moat, vulnerable.
Whereas the classic example, Coca-Cola, which the source also mentions.
Right.
You can make a cola drink, lots of companies do. But replicating that brand, that global distribution, the sheer habit people are in.
Forget about it. That's a deep, wide moat built over decades.
Mm-hmm.
It's incredibly hard, maybe impossible to replicate that now. It's about protection that lasts.
Okay, so we understand the concept. How do we break it down? The source material gives us 5 main types of these economic moats, like the different walls or defenses of our castle. First one, intangible assets.
Right, intangibles. These are the things you can't easily touch or put a number on directly, but they provide real protection. Think strong brands.
Like Apple, Nike. People pay a premium for the brand itself.
Exactly. Or patents, which give you a legal monopoly on an invention for a period. Very important in, say, pharmaceuticals.
Okay.
And then there are regulatory licenses, things like banking licenses, or the right to operate as a utility. You can't just decide to start an electric company. You need government approval, which is a huge barrier.
So these intangibles, they give you pricing power or make customers stick with you. Like the Coke example, again, the brand lets them charge more.
Precisely. That brand loyalty, that reputation, it's built over years, and it's very, very hard for a competitor to just conjure up overnight.
All right, moat type number 2, switching costs. This sounds like making it painful for customers to leave, like that moat filled with sticky tar you mentioned.
Yeah, it's a good way to think about it. Switching costs are basically any friction, could be financial cost, could be the hassle, the time, even emotional attachment that makes it difficult for a customer to ditch your product for a competitor's.
The source mentions Adobe's Creative Suite. That feels spot on.
Oh, definitely. If you're a designer, you've maybe spent years learning Photoshop, Illustrator, all those tools, your whole workflow is built around them.
The thought of switching to a whole new ecosystem.
It's daunting. The cost, the time to relearn everything, retraining staff maybe, it's significant. That's a powerful switching cost. That creates stickiness.
Makes sense. So customers stay put unless the alternative is just overwhelmingly better or cheaper.
And even then, sometimes the sheer pain of the switch isn't worth it. That's a solid moat.
Okay, third type, network effects. This is where the product gets better as more people use it, like the castle becoming more desirable because more people live there.
Exactly. The value increases for everyone as the network grows. Classic examples are social media platforms like Facebook or marketplaces like eBay, Uber, Airbnb.
Right. More users on Facebook means more people you can connect with, making it more valuable for you.
And more riders on Uber attract more drivers because there's more business, which means shorter wait times for riders, which attracts more riders.
It feeds itself. A positive feedback loop.
It does. And as the source notes, it can create this exponential lock-in. If you try to launch a competing social network now, you start with 0 users. Who wants to join?
It's a huge disadvantage compared to the established network.
Massive. It's an incredibly powerful moat once it gets going. Very hard to break into that.
Okay, number 4, cost advantage. This is basically being able to do things cheaper than anyone else, like having that secret cheap supply line for the castle.
That's the core idea. Being able to produce or deliver your product or service at a structurally lower cost than your rivals and doing it sustainably.
How do companies get that?
It can come from a few places. Maybe proprietary technology or processes nobody else has. Better scale. The source mentions Walmart's huge buying power.
Right, they buy in such massive volumes, they get discounts that smaller stores just can't match.
Exactly. Or maybe unique access to a cheap resource or a better location. Whatever the source, if your costs are lower, you have options.
You can either undercut competitors on price and steal market share.
Or you can charge the same price as everyone else, but enjoy much healthier profit margins. Either way, it's a strong defensive position.
Makes sense. Okay, 5th and final type from the source. Efficient scale. This one feels a bit different, like a market that's only big enough for one player.
That's a good way to put it. It applies to markets, often geographically limited, where the demand is really only enough to support one company profitably.
So trying to add a second competitor would just ruin the economics for everybody.
Pretty much. Think about a small town. Does it make sense to build 2 separate water pipe systems? Or 2 competing airports right next to each other in a small region? Usually not.
The source uses that water company example. The cost to duplicate the infrastructure is huge, and the market just isn't big enough.
Exactly. So the first company to build that infrastructure often has a natural monopoly, or near monopoly, in that specific market. It's an efficient scale moat. Limited market, high fixed costs.
Interesting. So that covers the 5 main types. Now, stepping back, why is understanding all this so critical for, someone listening who's interested in investing? Why focus so much on moats?
Because, fundamentally, a company's value today is based on the cash it's expected to generate in the future.
Okay, future cash flows.
Right. And moats are what protect those future cash flows. If a company's making great profits now but has 0 protection, 0 moat.
Competitors will flood in.
They absolutely will. That high profitability acts like a beacon. New entrants arrive, they compete on price, margins get squeezed, and those lovely profits you were counting on, they shrink or even disappear.
So the money machine you thought you invested in gets broken or copied really fast.
Precisely. A strong, durable moat acts like a shield for those profits. It allows the company to keep generating cash, maybe even grow it, year after year despite competition.
Which leads to compounding returns over the long haul.
That's the goal. It's about finding companies that can defend their profitability over time. Identifying that defensibility is key.
And the source makes another really important distinction. Moats are usually about the company, not the industry.
Oh, that's vital. You can't just say, oh, tech is a good industry, so all tech companies have moats, or airlines are tough, so no airline has a moat.
It's not that simple.
Not at all. The source uses the airline example historically, a brutal industry for investors. Yet Southwest Airlines carved out a specific niche and built a powerful cost advantage moat with its unique operating model, even while many others struggled or failed.
So even in tough industries, a specific company might find a way to build defenses.
Correct. And conversely, you can have companies in seemingly attractive industries that actually have very weak defenses against competitors. You have to look at the specific company.
So it means looking deeper than just revenue growth or current profit margins. You have to ask those hard questions the source implies. How specifically does this business stop others from eating its lunch?
What are the barriers? Can someone else just copy this easily?
And crucially, is that protection likely to last for, say, 10, 20 years, not just next quarter?
Yeah. Assessing the durability of those defenses, that's where the real analytical work comes in. Separating the truly great, long-lasting businesses from the ones that are just having a good run.
Well, this has been a fantastic breakdown based on the source material. We've covered what a moat is, the castle analogy, Buffett's view, and those 5 key types and tangibles: switching costs, network effects, cost advantage, and efficient scale.
And hopefully we've made it clear why spotting these moats is so important for protecting long-term value if you're investing. It really sets us up for thinking about, well, how strong is this moat really? Is it genuine or just an illusion?
Exactly. The source material kind of tees up some deeper thinking. So let's leave you, the listener, with a few things to chew on based on what we've discussed.
Okay.
First, think about switching costs versus network effects. They both create stickiness, but how are the mechanisms different? And does that difference affect how strong the defense is?
Good question.
Second, cost advantages. Can you think about how a company's cost advantage might actually fade over time? What sort of market changes or competitor actions could erode that moat?
Yeah, what makes it less durable?
And finally, brands. We talked about strong brands like Coke or Apple being moats, but why might a really well-known brand in maybe fashion or retail not be as strong a moat? What makes some brands more defensible than others in this economic sense?
Thinking about those kinds of questions, really digging into the why behind the moat types, will definitely help cement the understanding.
Absolutely. We hope this deep dive has given you some valuable tools and frameworks for analyzing business moats and the long-term durability of companies.